Hey, today I'm here with Jerry Garner. He's with Mutual of Omaha. And we're here to talk about something pretty specific. It's not for everybody. It's actually not even for me. And you'll find out why. Not good or bad, but it's not my product yet. It's a home equity conversion mortgage for purchase program. Did I get that right?
That's correct.
That's a big old mouthful there, but I will tell you, I did study a little bit before you got here. So I've done a couple of these with my clients, with Jerry, and like I said, it's a really specific program, but for the right person, and not a ton of people know about it. I think it's something that might make sense. Can you give me the Cliff Note version, high-level view of what the program is?
Of course. Well, thanks. Thanks for the opportunity. So, home equity conversion mortgage, HECM, not hiccup, but HECM, home equity conversion mortgage. It's an age-based product. Hence the term, the reason why he said he's not eligible yet. He's a child.
Well, I haven't been called that for a long time, and I'll take it.
As an age-based product, it's actually an FHA loan, the Federal Housing Authority. It's been around since 2009, so we've got about a 12-year track record. And the home equity conversion mortgage is used to purchase a home. Age-wise, the buyer needs to be at least age 62. Now, if it's a married couple, only one of you needs to be age 62. So age 62 or older, buy in your primary residence. You have three typical options. A, pay in cash. Is there a median purchase price in this market? What would you say?
It's gone up. It's closer to $300,000 now.
So if you're watching and you're thinking about moving to the Summerville, Charleston, and the surrounding metro area, you're looking to spend around $300,000. You have three options. A, pay cash. So if you're in a home, you can run the numbers. Am I going to pull $300,000 or more out when I sell it so I can go pay cash for a home? You don't mind cash buyers?
No, I love cash buyers.
There's cash. So if you have it, that's A. B is conventional financing. You might not have $300,000, so we can talk to you about a conventional loan, and you get pre-approved and you pay for 15 or 30 years. Now, if you're age 62 or older, you might not A, have $300,000, B, want a payment for 30 years. So what was happening is we would just sit on our hands and say, well, you know what? Maybe we can't afford to buy that ideal house for retirement because I don't have enough cash. I don't want a payment. So we'll just stay here in this old fixer-upper house and we'll deal with repairs. Well, in 2009, HUD, the Housing of Urban Development, says, wait a minute, we got to find a way in which our baby boomers and seniors or seasoned buyers can age in place. Find that ideal house, close to family, close to friends, the kitchen you may have never had. There's a lot of amenities in some of these 55-plus communities. Now, the property doesn't need to be in a 55-plus community. It can be any type of home. So with the HECM, the abbreviated explanation is you make a one-time cash down payment of approximately 50% of the purchase price. So if you're buying a $300,000 home, you're going to bring $150,000 cash to closing. You're going to borrow $150,000 from Mutual of Omaha. So you're going to purchase a $300,000 home. The deed, the title's in your name. You are responsible for your property taxes and your home insurance. But the HECM has an incredible benefit. There's no required monthly payments. So you put your $150,000 down, you own a $300,000 home, and you have no monthly payments. This is not a 30-year term, a 15-year term. As long as you live in the house, you'll always maintain ownership and have no payments. So it's an incredible, little-known strategy to leverage to get to that house you really like.
All right, so a couple questions. So if they're living in the $300,000 house now, but they say, listen, we want to house up but not necessarily increase payments. So now we were to sell that $300,000 and we were to walk away with, $250,000 in cash. We could then turn that, let's say $250,000 in cash, into the purchase of a $500,000 house and still have no mortgage payments whatsoever.
Yes. So there's a lot of studies out there. The National Association of Realtors. Right now, about 38% of all buyers are over the age of 62.
Okay.
There's 10,000 baby boomers a day turning 62. All right. So one of the most obvious item that they compromise on, what they're giving up, they're calling it price point. What we're calling is they don't think they can afford the house they really want. So yeah, in this example, you sell your $300,000 house minus any cost of the transaction, you got $250,000 in your hand. you now can start looking at a $500,000 home.
And what happens if husband and wife purchase that home, husband dies, wife dies, what happens with the other spouse?
So it's a mortgage. The house, the deed is in your name. We have a mortgage on it, and the mortgage is due when all borrowers have permanently vacated the house. So if it's a married couple, if Mr. Jones, as an example, passes away, Mrs. Jones can stay in the house the rest of her life and have no payments. When both of them pass away, the house is going to go to the estate. The executor of the estate, which is typically the children, have up to a year to pay off the HECM, the home equity conversion mortgage. Either sell the house, which is typical. They can refinance it and keep the house, start making payments. Or if there's cash, life insurance, they can pay it off that way as well.
So let's go devil's advocate, worst case scenario. They buy the house when they're 62. They live to be 102. So we've been racking up this mortgage over the course of 40 years.
Yep.
The housing market crashes when they move out of the house or pass on. And so now the house is worth even less than what would be needed to pay off the mortgage.
Yes.
How are the heirs affected on that?
Great point. So what is the role of the Federal Housing Authority? There is a mortgage insurance premium. There's a 0.5 monthly. So the interest rate is going to be about half a point to a point higher than a conventional mortgage. And that additional mortgage insurance premium creates what's called a non-recourse loan.
Okay.
Non-recourse. And great question. And I tell everybody, I could fill this room and this conversation up full of sunshine for hours talking about the benefits of this program. But let's talk real quick about the gotcha, the catch, the worst case scenario.
Yeah.
62, you bring your $250, you borrow $250 from Mutual of Omaha, and you own a $500,000 house, and you live in the house for 40 years in this example, and you never make a payment. And the value of the home doesn't keep up with the interest, so we get upside down. When the borrowers both pass away and the kids inherit the house, if the kids cannot sell the house for enough to pay off the mortgage, they are not responsible for the debt. They would hand us the keys and walk away. Mom and dad bought a $500,000 house 40 years ago with $250,000, never made a payment. The housing market crashed as an example, but the kids will not be responsible for a penny. So that's my gotcha, my catch is, I don't know how long the homeowners are going to live. I don't know whether or not they are going to make payments. I don't know what the house is going to appreciate at. So worst case scenario, I don't know how much equity is going to be left for the kids.
Right.
And that's usually when someone will look at me and go,
well, I would think for this buyer, let's say the average 70-year-old person, they care about a couple things here. Number one is, where am I going to be living?
Yep.
And depending on the family, even more important, are my kids going to get hurt? Is there any scenario
Correct.
that my kids get hurt from me making this move? And it sounds like no.
There's not, and what we can do is we can run amortization schedules, and I can show you, okay, typically, if you don't make payments, so again, you write a check for $250,000 and you borrow $250,000, so you buy a $500,000 home, it's going to take on average 17 years for your balance to grow to that $500,000. So you live in the house for 17 years, you don't make the payment, the house hasn't appreciated, you're going to run out of equity in 17 years. And so we have that straightforward analogy. And then we compare it to a conventional mortgage. Well, that $500,000 purchase, you put 20% down, so you put $100,000 down. You finance $400,000. Let's say you get a 3.5% rate. Your payment's $1,700 a month. Well, we can do $1,700 a month times 12 months in a year times 17 years, and we can see what your total of payments, how much money you pulled out of your pocket towards a conventional loan versus the home equity conversion mortgage. And you can make a decision which is right for you and your family. A third of the people that call me, it's you. It's the kids. It's not mom and dad calling. Mom and dad are in Ohio. They're in Vermont. They're in Charlotte, North Carolina. They're in Columbia. They're in Florida. The kids are here with Bosch or Boeing or MUSC. With all that we've been going through with COVID and the restrictions and the changes, they're finally jumping off the fence and they're coming to Charleston.
Yeah.
They're coming to Summerville. So the kids are calling going, how does this home equity conversion mortgage work? So whether you're 62, 82, or 32, give us a phone call. We have free consumer guides. I can run free custom proposals from start to finish. If you find a resale, it takes us 30 days to get you in that house.
So that's a big piece of your business is I want to buy the $500,000 house and it only cost me $250 down. The other side of it is, and I've experienced this with my clients, it's actually my parents. So my parents had the ability to purchase their home for cash. So they were going to buy a $400,000 house, and they'd sold their house. They were cash buyers. It made sense for us if the interest rate of the mortgage is here and their investments are here. Making up numbers. If it's 4%, but they're making 7% on their money, what they did was bought the home for $200,000, and then they went and invested that other $200,000. So now it is going to continue to grow at whatever investment percentage they have.
Correct.
So I'm assuming there's some piece of your business is just cash buyers that don't even care about putting down, half. They have the ability to spend 100% if they wanted to, but they realize their investments will make them more, and they go that way.
There's a lot of misconceptions out there with certain type of financing. This being one of them is that we are dealing today with what we call the mass affluent. The mass affluent have between $500,000 and about $1.5 million in assets, including the home, the equity in their home. I ask people all the time. So let's just assume you have $1 million in liquid assets. Would you take half of it, $500,000, and go buy a single stock? And they all go, no, because I could go down.
Right.
But we do it every single day with a house, and they can go down. So when you start pulling back and saying, wait a minute, instead of putting $500,000 liquid cash into the dirt, let me put $250 in it, and this other $250, I have control of it. I can put it in international stocks. I can put it in a bond. I can buy gold. I can mutual funds. And I have access to it.
I encourage my parents to buy stuff for me, but that's not everybody's like that.
Once you put money into a house, or if you've been making payments over 20, 30 years, how do you get that money back? A, sell it, or B, you have to go through a refinance. You have to qualify. So again, as we started, this home equity conversion mortgage, is it right for you? We don't know. There's no financial product that's right for everybody. Life insurance, stocks, bonds, mutual funds, same thing here. But getting the facts costs zero. And we can run amortization schedules that you can compare pay in cash, conventional financing, the home equity conversion mortgage to see what fits right for you. Because for 22 years, I was a loan officer. I'm today, get this, my title, you ready?
You bring it.
Home Equity Retirement Specialist.
That's snazzy.
How about that?
That looks good in the business card.
Hey. So yeah, we talk rates and fees and closing costs and what attorney you're going to use and who your homeowner insurance agent is. But how does a house fit into your retirement plan? And some people are like, I don't have a plan.
Yeah.
Well, so that's the fun part about it is just, I didn't know I could afford a house with this type of kitchen. I didn't know I could afford a house with a resort and a pool or this close to my grandkids. Well,
right.
You might be able to.
One of the things that Mark and I really try to do is align ourselves with the people that are just the best at what they do, be that our home inspectors that we work with, our mortgage companies. Jerry is, he is at the top of his game here in the Charleston market. I know that we've worked together in the past. But one of the things that I really respect about Jerry is that he'll come to you and give you options that make sense. And if a regular conventional mortgage make more sense, he'll tell you that. Yep. He only wants to do this with, just like Mark and I, with people that like to do business with us, that understand what we're trying to do. This isn't going to make sense for everybody, but for those that it does make sense for, I think it's a home run. It really opens the door to accomplishing, two different scenarios. You want to buy that house that you just don't have quite enough money to buy, or you don't want to tie up all your money in that one stock, in that one thing, and then not have access to your money or be able to use it to make it grow. So
I've closed just north of 3,000 of these home equity conversion mortgage, and I would say 9 out of 10, they have the cash. Because when we pre-approve someone for any type of mortgage, you know how it is. We're getting shoe size, bank statements, blood types, income, pay stubs. We get all that. So I see that, hey, they have the ability to write a check for $350,000.
Yeah.
But they want to make sure they have enough money, because the number one concern that we all have, whether you're 51 like myself, just a young child like this guy here, your parents, your grandparents, do we have enough money saved to maintain our lifestyle?
Yeah.
And that's really what we circle around buying this next house.
And a significant number of Mark and I's clients are people from New Jersey, New York, California, where they have sold their house. We just had one recently. They sold their house for $1.4 million. They only had $400,000 in their mortgage, and so they were coming to Charleston with $1 million in cash to buy a house. Finding the $450,000 house here that was equal to what they just sold in California. So there's a lot of cash buyers that are coming, and I think this makes sense to.
Let me give you just a quick success story. So there's a gentleman, let's call him John. John had a condo in Florida. The condo was free and clear. He bought it with his wife about 12 years ago. His wife was battling dementia. Okay, so she passed away. But he sold the condo after real estate fees. He had $310,000 cash in hand. He's coming up this way. He's actually looking to buy in Bluffton, South Carolina, in a Sun City community. Those houses are around $350,000 to $400,000. He has very little to no savings. All he has is cash in his pocket from the sale of the condo, but he has no place to live.
Right.
So now what he's able to do is he's going to buy a $310,000 home. So out of his approximately $300,000, he's putting $150,000 in it, buying a brand new single-family residence and have no payments, and now has $150,000 in savings. So brand new home, no payments, and $150,000 in his savings account. Yeah. And his question, which I get all the time, why is everybody not doing this?
When you and I first met, I kind of had the attitude, what's the catch? Why is this not more common? And it's just that, first of all, a lot of realtors, am I right, don't even know this exists, let alone understand it.
You are so far ahead of the curve.
Yeah.
They're coming. I mean, it's the fastest growing product that we have across the country, and it's coming. But it's easy just to stay in your lane.
Yeah.
You got cash buyers, you got conventional buyers, and then you've taken the time we've sat down many times and talked to many clients together, and sometimes you're driving around and you bring up home equity conversion mortgage and they just, what are you doing? So many realtors just don't even bring it up, but you're doing a disservice.
Yeah.
You're doing a disservice.
For the right person, I think it's a great product. If you have any questions on this or any other mortgages or properties, give Mark and I a call. We'd love to chat with you. Jerry, thank you, brother.
Thank you. Thank you. Thanks, everybody.